You are 24, and for the first time in your life, the numbers start to feel real. The salary hits your account every month with a consistency that feels like progress. And somewhere between your first few payslips and your late-night scrolling, the idea begins to take shape, not as a plan, but as a quiet belief that you've earned something more than just savings, something visible, something that reflects who you are becoming. And that's when the car enters the picture, not just as a vehicle, but as a symbol, a marker that you are no longer where you started. At first, the decision feels rational enough. You calculate the EMI, you compare models, you convince yourself that you're not overspending, but simply upgrading your life to match your income. And when you finally take delivery, the experience reinforces everything you believed. The smell of a new interior, the smoothness of acceleration, the subtle attention you get from others. It all feels like confirmation that you made the right call, that this is what progress looks like when it becomes tangible. But the shift doesn't happen immediately. It's gradual and almost invisible, because the car itself doesn't just sit in your driveway. It starts to reshape the structure of your finances. The EMI becomes a fixed obligation. Insurance adds another layer. Maintenance quietly enters the background. Fuel costs fluctuate but never disappear. And before long, what once felt like a reward begins to act more like a system you have to sustain. By the time you reach your late 20s, your income has likely increased, but so have your expenses, not only because of the car, but because the presence of that car influences other decisions. You're more comfortable spending on convenience, you're less sensitive to small recurring costs, and your baseline for what feels normal quietly shifts upward, not through a single decision, but through a series of small adjustments that feel justified in the moment. This is where the psychological layer becomes more important than the financial one, because the card didn't just change your expenses, it changed your reference point. It altered how you perceive affordability, how you evaluate trade-offs, and how you respond to future financial decisions. And once that reference point moves, it rarely moves back on its own. At the same time, something else is happening beneath the surface, something that doesn't feel urgent, which is why it's easy to ignore. The opportunity cost of that decision begins to compound, not in a dramatic or obvious way, but quietly, consistently, over time. Because every fixed expense reduces the amount of flexibility you have, not just in your monthly budget, but in your ability to take risks, to invest, to delay gratification for something larger. If you were to step back and look at the math, not as a single purchase, but as a system over time, the picture becomes clearer. The EMI you committed to at 24 doesn't just represent a payment, it represents a stream of cash flows that could have been allocated elsewhere. And while the car itself depreciates, losing value each year regardless of how carefully you maintain it, the alternative uses of that same money, if invested or even partially redirected, would have followed a very different trajectory. By the time you reach your early 30s, the contrast becomes harder to ignore. Not because the car has failed you, but because your financial awareness has evolved. You begin to see patterns you couldn't see before. You notice how fixed costs limit optionality, how lifestyle decisions made early tend to anchor future behavior, and how certain purchases don't just cost money, they shape the way money flows through your life. At 34, the regret doesn't usually come from the car itself. It comes from the realization that the decision was never just about the car. It was about timing, about choosing consumption at a stage where flexibility had a higher long-term value, about locking in a cost structure before your financial system had the chance to fully stabilize and grow. This is where the broader system reveals itself, because modern financial environments are designed in a way that makes early consumption feel accessible and reasonable. Credit systems reduce the immediate friction of large purchases. Marketing reframes wants as milestones, and social signals reinforce the idea that visible upgrades are indicators of progress, even when the underlying financial impact is more complex. The result is not a mistake in the traditional sense, but a trade-off that wasn't fully visible at the time, because at 24, the future is abstract and the present is vivid. The car is real, immediate, and emotionally satisfying, while the long-term effects exist only as projections, easy to discount and even easier to postpone. What changes over time is not just your income, but your perspective. You begin to value optionality more than appearance, flexibility more than status, and systems more than symbols. And when that shift happens, earlier decisions are reevaluated through a different lens, one that prioritizes long-term structure over short-term expression. The key insight is not that buying a car early is inherently wrong, but that every financial decision operates within a system, and the earlier you make high-commitment decisions, the more they influence the trajectory of everything that follows. Because money is not just about what you spend, it's about what you commit to repeatedly, month after month, year after year. And when you look back from 34 to 24, what stands out is not the purchase itself, but the pattern it created, the way it shaped your baseline, your expectations, and your financial rhythm. And that is where the real cost exists, not in the initial price, but in the long-term structure it quietly built around your life. Understanding this doesn't change the past, but it does change how future decisions are made. Because once you recognize that every major purchase is not just a transaction, but a system, you start to evaluate it differently, not by asking whether you can afford it today, but by asking what kind of financial environment it will create over time, and whether that environment aligns with the version of your life you actually want to build.